In this one, we're going to talk about how to record dividends. In this example, the company is paying $40 of dividends to its owners. Let's start with the what you give up, because it's hopefully evident here that we're going to pay $40 in cash. So you're going to give up cash. Cash is the account title. It decreases assets by 40. So down goes our 40. Now what's the other side? What is the company getting? Well, this one's a little hard to see, but I'd like you to understand that when you have dividends, what you're doing is you're actually getting some ownership back as the company. Remember, the company is separate from the owners. So when the company gives a dividend, you're basically decreasing the owner's claims to its assets. You're giving them some of the assets, hence reducing it. The account title we use is dividends, and it's a shareholders' equity account, and like expenses, it decreases shareholders' equity. So we're going to decrease shareholders' equity for the amount of dividends. So dividends shrink the owner's investment in the company, because if the company retained those earnings instead of paying them to the owners, the company would have been larger. So now the resources, if you look at it this way, dividends shrink shareholders' equity because the company's giving up some of its resources, some of its assets, and giving it to the owners. I want to remind you that dividends is a financing activity. Any cash between the owners and the company are financing activities. So dividends, again, like expenses, reduce shareholders' equity. So remember, good old REDS: revenues, expenses, dividends, and stock. Dividends, like expenses, reduce shareholders' equity. Revenues and stock increase shareholders' equity.